Getting a mortgage is the essential part of buying a home. But how is a mortgage different from a loan? And what type should you get? Watch this video to find this out and more. Hi, if we haven't met before, my name's Dan and I'm a CMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or a recommendation to act. And I must stress your home may be repossessed if you do not keep up with the repayments on the mortgage. Throughout this video, I will reference to other videos I've created. To prevent this video being too long, I strongly recommend you watch these afterwards. Unlike a personal loan, a mortgage is specifically tied to the house you're buying. When you buy a home, you'll put down a cash deposit, which is usually at least 5% of the property price, and you pay for the rest using a mortgage from a bank or building society. If you fail to pay your mortgage, your property could be taken away and sold to cover the loan you've taken out. When you are buying a house for yourself, there are three types of mortgages. You have repayment, interest only, and part and part. But repayment and interest only are the two main types. With a repayment mortgage, you gradually repay back the amount you borrowed. This part of the mortgage is known as the capital. Each month, some of what you pay goes towards reducing the balance on the mortgage, and the rest covers the interest. By the end of the mortgage term, which is typically between 25 to 30 years, you would have repaid back everything you've borrowed. An interest-only mortgage usually has lower monthly payments. This is because you aren't actually reducing the balance of the mortgage, you're just paying the interest each month. It is then down to you to repay back the capital either during or at the end of the term. Watch this video where I talk about the positives and negatives on both repayment and interest-only mortgages and also discuss part and part. Lenders typically charge on a new mortgage an introductory rate to encourage you to take out a mortgage with them. Once this introductory deal is over, you're likely to go onto the lender's standard variable rate. There are two main types of mortgage rates, fixed and variable. A fixed rate gives you the peace of mind of knowing what your payment will be each month. A variable is not fixed and your payment can change if the interest rate moves up or down during the term of the mortgage. This means you could potentially pay less compared to a fixed rate, but it can also cost more if the rate goes up. With variable rates, there are different types. You have tracker mortgages, discount mortgages, and capped and collar, to name a few. I've covered this in greater detail in this video. Please speak to a qualified mortgage advisor like myself before opting for a variable rate, or carry out a significant amount of research yourself. If you would like more information on why you'd consider using a mortgage advisor, watch this video. There are some things you need to consider to help decide which deals are available to you. These are: how much deposit do you have saved? Are you buying a house, flat, or a new build property? How long do you want to be paying the mortgage back for? How much can you afford in the monthly mortgage payments? Are you wanting to use any schemes such as the Help to Buy? I've created a few helpful videos which cover some of these topics, so don't forget to check them out after this video. Comparing deals. The best way for me to cover this subject is in fact divert you to this video about remortgaging. In this video I cover the topic in detail, and I know you're not at this stage yet, but not only will it help you now, it also helps you plan for the future. What is an agreement in principle? When you're ready to start viewing properties, estate agents might ask whether you have a mortgage agreement in principle, known as an AIP, or decision in principle, known as a DIP. An AIP is the bank or building society saying that they are, in principle, willing to lend to you a certain amount of money, subject to the full affordability checks being passed. Having an AIP can help prove your budget to estate agents and show the sellers that you're a serious buyer. However, having one won't always be necessary and could in some circumstances make a dent in your credit score. So ask estate agents in your area whether you'll need one before applying. How long does a mortgage offer last? When you apply for a mortgage and receive a formal offer from a lender, it will usually only be valid for a certain amount of time. Please do not get the mortgage offer confused with the decision in principle. This is a common mistake and they are two entirely different things. Most mortgage offers last for 3 to 6 months, although longer offers are available on new build homes, and if you don't complete your purchase in this time, you'll need to ask for an extension. In some cases, this means that you might have to go back through the bank's application process. I hope I've covered off some of the basics, but there is a lot more that you need to know. I've created a very handy first time buyer's guide, which can be found here. If you found this video helpful and you wish to buy me a coffee, I've put a link in the description below. But even more importantly, if you need my help, please contact me. Remember, your home may be repossessed if you do not keep up with the repayments on your mortgage. Thank you very much for watching. I'll see you next week.